At the end of the last episode, I left you with a question. A biotech company announces positive clinical trial results. How excited should you actually be? Today we answer that with a puzzle. A rare disease affects 1 in every 1,000 people. There's a test for it, and the test is 95% accurate. You take the test, it comes back positive. What's the probability that you actually have the disease? Most people, including most doctors, by the way, answer 95%. It seems obvious. The test is 95% accurate, so if it says you're positive, there's a 95% chance it's right. The actual answer is about 2%. Here's why. Imagine testing 1,000 people. On average, one of them actually has the disease. The test correctly identifies that person. That's our one true positive. But out of the 999 healthy people, 5% get a false alarm. That's about 50 false positives. So out of 51 total positive results, only 1 is real. 1 out of 51. That's roughly 2%. The test didn't lie. It performed exactly as advertised. The mistake was yours. You ignored the base rate. The disease is so rare that even a highly accurate test produces far more false alarms than real detections. Investors make this exact mistake every single day. In 1973, Daniel Kahneman and Amos Tversky published a paper called On the Psychology of Prediction. In it, they demonstrated something remarkable. When humans make judgments under uncertainty, they systematically ignore the base rate, the background frequency of how often something actually happens. The base rate is the starting point. It's the answer to the simplest possible question. In general, how often does this kind of thing succeed? But instead of checking the base rate, our brains reach for 2 shortcuts. The first is the representativeness heuristic. We ask, does this look like a success story? A biotech company with a charismatic CEO, a breakthrough mechanism, and glowing press coverage looks like Moderna. So we mentally file it under probable winner, without checking how often companies that look like Moderna actually become Moderna. The second is the availability heuristic. We ask, can I easily recall a similar success? If your friend made 5 times their money on a biotech stock last year, that memory is vivid and available. It feels like evidence that biotech investments work, even though it's a single data point. Both shortcuts feel rational. Both lead you away from the one number that actually matters, the base rate. This company could be the next Moderna. Maybe, but what's the base rate for that category? That IPO stock went 5x in 6 months. Sure, but what percentage of IPOs actually do that? These are the questions that base rate neglect causes you to skip. Let's put real numbers on this. 4 categories of investments, 4 base rates that might change how you think about your next trade. Case 1. Biotech stocks, the dream factory. Phase 3 success, FDA approval imminent. The stock jumps, your finger hovers over the buy button. Stop. Check the base rate. According to data from Bio and Informa covering 2011 to 2020, about 58% of drugs that enter Phase 3 clinical trials eventually receive FDA approval. That's better than a coin flip, but it means 42% of Phase 3 drugs fail, almost half. Now, of those that do get approved, how many become blockbusters, generating over $1 billion in annual revenue? About 20%, based on the last decade of data from Evaluate Pharma. Multiply those together. 58% times 20%. The probability that a drug entering Phase 3 becomes a blockbuster is roughly 12%. And if you use historical averages from the 1990s and 2000s, that number drops to about 6%. 12%. That's the base rate. Not 95%, not almost certain, 12%. When you hear Phase 3 success, your brain hears a done deal. The base rate says 1 in 8. Case 2. Growth stocks, the myth of eternal growth. This company has grown revenue 50% a year for 3 straight years. Imagine where it'll be in 5 more. Let's imagine, with data. Michael Mauboussin at Morgan Stanley analyzed over 50,000 companies. How many sustained a 30% or higher annual growth rate for 5 consecutive years? About 1%. 502 out of 50,000. 10 years? Less than 0.6%. And here's the uncomfortable implication. When you buy a stock at a price-to-earnings ratio of 50, you're implicitly betting that this company will sustain extraordinary growth for many years. You're betting it belongs to the 1%. That might be a bet worth making, but you should make it with your eyes open, knowing exactly how rare sustained high growth actually is. Case 3. IPOs, the excitement trap. There's something irresistible about an IPO. First day of trading, growth potential, institutional buzz, the fear of missing out. Jay Ritter, a finance professor at the University of Florida, has studied IPO performance for decades. His findings are consistent and sobering. Yes, IPOs tend to pop on their first day, an average gain of 15 to 20% above the offering price. That's the part everyone remembers. But look at the 3-year horizon. Only about 30% of IPOs outperform their benchmark over 3 years. The other 70% underperform. Why? Because companies go public when it benefits them, when valuations are high and market conditions are favorable. An IPO is designed to be a good deal for the company, not necessarily for you. Case 4. Analyst price targets, the expert's coin flip. A top analyst just set a price target 40% above the current price. How reliable is that? Studies consistently show that 12-month analyst price targets are hit only about 30 to 50% of the time, depending on how you define hit. More telling, the directional accuracy, whether the analyst correctly predicted whether the stock would go up or down, is roughly 54%. That's barely better than flipping a coin. And there's a systematic bias. On average, analyst price targets sit about 9.4% above the actual price. Analysts are structurally optimistic. They're not lying, but their incentives and psychology push them to see the upside more clearly than the downside. So how do you actually use base rates in practice? Here's a simple 3-step framework you can apply to any investment idea. Step 1. Define the category. Before anything else, ask, what kind of investment is this? Is it a biotech play, an IPO, a turnaround story, a high-growth compounder, a deep value play? This matters because base rates vary enormously across categories. A Biotech Phase 3 bet and a large-cap dividend stock are completely different probability games. Step 2. Find the base rate. Ask, what is the historical success rate for this category? Look for academic research, industry data, SPIVA reports, anything that gives you the background frequency. If you can't find an exact base rate, find the closest comparable one. Imprecise base rates are still vastly better than no base rate at all. Here's a quick reference. Biotech Phase 3 to blockbuster, roughly 6 to 12%. High-growth stocks sustaining 30% for 5 years, about 1%. IPOs beating the market over 3 years, about 30%. Unprofitable companies reaching profitability within 3 years, roughly 25%, varying heavily by sector. Active funds beating the index over 15 years, about 10%. And analyst price targets being hit, 30 to 50%. Step 3. Prove the exception. Now, and only now, ask, why should this specific case beat the base rate? This is where most investors go wrong. They skip straight to this step without doing the first 2. The CEO is visionary. The technology is revolutionary. The market opportunity is enormous. These are narratives, not evidence. What counts as evidence? Concrete, verifiable facts. The FDA Advisory Committee voted 15-2 in favor. The company has been profitable for 2 consecutive quarters after years of losses. Customer retention is 95% with zero churn in enterprise accounts. If your reason for believing this case is special can't be stated as a specific checkable fact, you're probably just telling yourself a story. Let's recap what we learned today. Base rate neglect is one of the most expensive mistakes in investing. Your brain is wired to react to stories, not statistics, and that wiring costs you money. Here are the numbers you need to remember. A biotech stock with positive Phase 3 results, the base rate to blockbuster is 12%. A growth stock that's been crushing it, the base rate for sustaining 30% growth over 5 years is 1%. An exciting IPO? Only 30% outperform the benchmark over 3 years. An analyst's price target? They're right about 30 to 50% of the time, barely better than a coin flip. 3 rules to protect yourself. First, before you invest, define the category. Is this a biotech, an IPO, a turnaround, a growth stock? Each has a different base rate. Second, look up the historical success rate for that category. Not anecdotes, not YouTuber opinions, actual data from academic research. Third, if you still want to invest, prove why this specific case should beat the base rate. Not with a story, with concrete, verifiable facts. Kahneman spent his career proving that our brains are strong on narratives and weak on numbers. The base rate check is the simplest tool to correct that wiring. Now, once you've checked the base rate, there's a second trap waiting for you. Am I seeing the full picture, or only the survivors? In 2020, the EV revolution was the hottest story in the market. Everyone remembers Tesla. But how many remember Lordstown Motors, Nikola, Workhorse, Archimoto? For every Tesla that survived, 4 EV companies became cautionary tales. Next episode, Survivorship Bias. Why we remember the winners and forget the graves. That's episode 4. See you then. Thanks for watching. If this changed how you think about investment odds, hit subscribe and the notification bell so you don't miss the next episode. See you then.